This is an interview with Professor Terrance Odean, a pioneer of behavioral finance at UC Berkeley's Haas School of Business. He studies how real people invest, why we trade too much, hold losers too long, and mistake confidence for skill. We talk about overconfidence, the disposition effect, bubbles and memes, long term thinking, and simple habits that make investing more rational and humane. So, your early life was very unconventional. You even dropped out of a seminary, hitchhiked across Afghanistan, drove a taxi in the 1970s, and later started your own statistical software company. How did these varied experiences shape your worldview and eventually lead you toward the world of finance and economics?
All right. Let's see. Just a couple caveats. I think the furthest I hitchhiked in Afghanistan was from Kandahar to Kabul. Uh, and I didn't start the statistical analysis company. My friend David Walnick did, but I worked with him for several years. But the overall question is a good one. I think there are advantages and disadvantages to having sort of a gap in your education. Uh, One big disadvantage is it can be challenging to come back to school. I had kids when I went back to school and while I was in school. And, it can just be, I dropped out of college with 5 months left. And I thought, oh, I'll be back in 2 or 3 years. And it was, 17 years. Uh, but you do get a different perspective. And I think there's some disadvantage to say, I'm in financial economics, to just going straight through school. You study hard, you do your problem sets, and there's some danger of getting indoctrinated. Like I have been in seminar settings where uh, it's a few years back, but people were saying, isn't it such a puzzle that so many Americans don't own stocks? And I'm thinking, a lot of people struggle to meet the rent or get that mortgage payment in. It's tough to start building a stock portfolio when you're worried about, paying your medical bills, paying your rent. Now, those numbers have changed a bit with defined, with 401ks and such, but still, it's not entirely a puzzle if you've lived in circumstances where the people around you were struggling. Now, of course, there are economists who also grew up without a lot of money, and some of those I know tend to actually have a wider perspective on, uh, on economics, on why people do what they do. But I think I benefited from having a variety of experiences, and I would also say there are reasons not to do that. It's getting, there's no guarantee. It can be tough to get back on the bus. you know uh you might find that you step off and it's time to get back on, and they say, no, you've been out too long, we're not that interested in you. I feel like I was incredibly lucky that UC Berkeley took me back, not took me back because I had been at Carleton College before that, but that as a 38-year-old trying to come back and finish a BA, that they accepted me. Uh, Glad they did.
So to begin with your career, you came to academia later than most. What experiences or turning points first convinced you that psychology and individual investor behavior were the keys to understanding markets?
Ah, well, I actually wanted to be a psychologist. That's what I was. Um, that was my plan when I came back, and it's a different story, but I was told I wouldn't be admit. I'd be less likely to be admitted as such as a student who'd been gone through, through so many years of school already, as a psych major, and so I chose to be a statistics major, which made some sense since I'd been working with statistical analysis software and I liked math. Uh, but my thought was, well, I'll get my undergrad degree in statistics and then I'll get a PhD in psychology. And I was very fortunate. I was fortunate to be at Berkeley at that time. I got to know Danny Kahneman. I don't know if you know who. He wrote the book Thinking Fast and Slow. He won the Nobel Prize in economics. I met him before that and got to know him pretty well. And I wanted to talk to him about grad school. He invited me to his house one morning, one Saturday morning. We went there. And basically, he said, if you really want to study psychology, I'll be happy to have you as a student, but I think you should consider getting a PhD in finance and trying to apply what I had learned about his work and his work with Amos Tversky and some of their associates, apply that to academic finance. He pointed out that academic finance at the time, that in academic finance at the time, the dominant paradigm was that markets were efficient and people were rational, and when they weren't irrational, they were behaved randomly and kind of canceled each other out. And Kahneman and Tversky's work basically said, no, people have systematic biases, and they're very predictable. They're not random, and they are pretty persistent. So I I thought about it, but I took Danny's advice and decided, okay, I'll go into finance and try to apply some of what I learned in his classes.
Shifting to trading behavior, in your influential work with Brad Barber, you found that men trade about 45% more than women and earn significantly lower net returns as a result. Why do you think these gender differences in trading frequency and overconfidence persist? And have you seen changes in recent years as more women participate in investing?
Well, there was prior research, not mine, that showed that in certain domains, men tended to behave more overconfidently. And those tended to be areas that uh, in our society were sort of perceived as in the male domain. Um, mathematical sciences, lots of areas of business, finance. I think that it's highly likely that there is some, genetic component to overconfidence, but I'm not, I don't, that's not my area of expertise. I don't know. There's clearly an environmental component to it and social norms. I wouldn't be surprised at all to find out that perhaps in another culture, this effect doesn't exist or is much smaller. And I suppose it could change over time. But when I was growing up, if you're in grade school when I was growing up, boys were told about things like math and that boys are good at this, and girls were told boys are good at this. So it's not that surprising in that environment that at least many of those boys grew up to be overconfident young men.
So continuing on trading outcomes, Barber and Odean, 2000, documented that the most active retail traders earned an annual return about 7 percentage points lower than buy and hold investors, largely due to excessive trading costs. Given today's commission-free platforms and constant news flow, do you think this trading is hazardous? Result still holds? How might zero commission trading impact investors' propensity to overtrade and their net returns?
Good question. If I could replicate that study today, what I would expect, but of course, I don't always get what I expect, but what I would expect is that the effect was much smaller, but wouldn't go away completely. So as you point out, a lot of what we found was that people who traded too much paid a lot more in commissions and more in bid-ask spreads, trading costs. Commissions, you know, The actual commissions are down to zero. Trading costs are not down to zero, but they're much, much, much smaller than they were in the 90s. We do have, Brad and a few other co-authors have documented some of the costs at different brokerage firms to trading, and they're not zero, but no one expected them to be zero. There's a spread that you pay, and many brokerage firms get a small kickback called payment for order flow from the wholesalers, such as Citadel, to which they send their trades. But the cost of trading is clearly down a lot, and that just mathematically is going to say the cost. If you trade a lot, your cost from from just trading is going to be down. The other part then would be, are you making better trades? I don't know the answer. I suspect the answer is no. I think that it's gotten very easy to trade, and very easy to trade impulsively, and very easy to trade because you read other people are doing it. And in some studies I've done, like, we've looked at when a lot of Robinhood investors all pile into the same stock on the same day. And by our calculations, and we're clear in the paper, we don't have the best data to do this analysis. We don't have trade by trade or account level data, but our analysis was that on average, the group of Robinhood investors was losing money on the days that they got excited and all bought the same stock, though clearly some of them were making money. And it's pretty obvious that it was the people who got to the party early that were probably making money, and those who piled on late into that little, like, mini bubble and bought near the top didn't do so well.
Turning to psychological biases, in your classic 1998 Journal of Finance paper, you demonstrated the disposition effect. Investors tend to sell winning stocks too soon and hold on to losers too long, which lowered after-tax returns. With modern tools such as tax loss harvesting services and robo-advisors, have you observed any reduction in the disposition effect among retail investors? What strategies or nudges might help investors overcome this bias?
All right. I haven't been able to observe, and that's quite simply because I don't have current account level data for retail investors. We do studies, we use a lot of different data sets and inferences to try to understand what investors are doing. There are other co-researchers who have some account level data. I've been working with some co-authors where we have account level data in for clients of a Dutch bank. But I don't know if the disposition effect, I'm sure it hasn't gone away. It's a pretty robust finding that you find it in lots of areas, lots of asset classes, lots of different groups of investors. You find it with institutional investors and retail investors, though less so with institutional investors, who are more likely to have learned and more likely to have put, kind of what you're calling the nudges. They're more likely to have put safeguards in place. Like, maybe the firm says to a young trader, you lose 10% on position, you sell it. Why? Because we don't want you falling in love with, your loss, or getting too attached to the thing that you bought and went down. So I doubt that it has gone away. I should also be clear that the disposition effect, if markets were efficient and there were no taxes, then it probably wouldn't matter if you were selling something for a gain or for a loss. One of the reasons, now, as you point out, if capital losses can be used to lower your taxes, which they can up to certain limits, and capital gains are raising your taxes, then the disposition effect is pushing you in the wrong direction. And that is one of the things I brought up in the paper. As far as tools go, of course, if you are, you probably have to be a reasonably wealthy investor to decide that you're going to, like, really focus on tax, very tax efficient, like tax loss harvesting and stuff. If you've got a couple $1,000 and you've got $20 in losses to harvest, not such a big deal. If you add a few zeros to that, it starts to get worth your while to be very tax efficient. For most retail investors today who are concerned about, well, I don't know. If you're concerned about capital gains taxes, you could buy like a S&P 500 or all market exchange traded fund. The funds are not perfectly taxed. They're not tax managed, but they tend to have fairly low internal turnover. The S&P 500 doesn't change that much every year. So they don't trade a lot relative to how much money you've got in the fund. And so the taxes tend to be fairly low. If you have a lot of money and you're in a high tax bracket, then you can look for tax managed funds. The thing is, a lot of people aren't doing any of this. If you are a retail investor looking at your phone trading on Robinhood, you're probably not saying, well, let's see, I should be holding a well-diversified, low turnover, low fee, and tax efficient fund. That's a different group of people.
So building on that, your research shows that news, media attention, and app design can captivate individual investors' attention and influence trading behavior. For example, intense buying of attention-grabbing stocks by certain retail users was followed by average short-term losses. How do you interpret this finding? Does it suggest that collective attention by novices create short-term bubbles? How have 24/7 news and social media, like Reddit's Wall Street bets, changed these attention-driven dynamics?
Oh, that's a good question also. So there's this term herding, which captures the idea that when we talk about investors, that investors do the same thing at the same time. And the evidence for that goes back quite a ways. Certainly there are studies in the 80s that show that there's herding in the sense that investors tend to be on the same side of the market, often for prolonged periods of time. I did some studies as well looking at herding, and when we wrote our studies in the early 2000s, we basically argued that herding was being driven by retail individual investors reacting to the same stimuli in the same way. They might react to a stock having gone up a lot. They might react to it being in the news. But it wasn't that, for most investors, it wasn't that they were buying because someone else was buying, which is what we think of, if you think that herding is supposed to be like a herd of buffalo or something, where they move because, to some extent, they're actually following each other. We didn't think the retail investors were following each other because they didn't have any good way to know what the others were doing. That has changed. Wall Street Bets has changed that. Reddit has changed that. It's, you may not get really useful information, but you can certainly get information about what other people say they are doing. And thus that is much more like actually, true herding. And speed has changed. So a friend called me up once, and Gillette had just come up with a new razor blade, and my friend was he was a retired market maker, and he said, Terry, you got to buy Gillette. And I said, why? He said, just had the smoothest shave of my life. And somewhat jokingly, I said to him, "Yeah, Jace, that's great, but people have been shaving on the East Coast for 4 hours now." Sort of like that's the efficient market story. Like the market should have already incorporated that. And I think a reasonable response by him would have been, yes, but there are people in Iowa who may not try this razor until, later this week or next week. And when they do, they're going to buy Gillette. So you should buy it today. I actually looked back and Gillette did get a fair amount of buying behavior for the few days around that, and it spread out. And I think this was true in many ways in terms of news dissemination for most of my lifetime. You know, something happened that was relevant. If it was really big, you could see it on one of the, there were three national television networks when I was young. You could see it on the nightly news. But it'd have to be pretty big because they didn't have a lot of time for news and they only had a little time for business news. Or you could hear about it once a week on Louis Rookheiser's Wall Street Week. Or you read about it in the newspaper the next day. So news disseminated more slowly. And the pattern of somebody buying, I think there were still a lot of people who said, "Oh, I just read this, I'm going to buy," and didn't say to themselves, "I just read this, but this news is already old. I'm not going to buy." People react to old news, maybe not months old, but and today it's much faster. I mean, it's just like tremendously much faster. Uh, Once there is relevant or perhaps even irrelevant news, it's on the internet. And that collapses the time in which a lot of things can happen, including retail investors all choosing to buy the same stock at the same time. So the price pressure comes faster. The time is more condensed. And I think that some of the patterns that we observe, and difficult to prove it, but it certainly looks like in times it's retail investors all getting excited about the same stock, bunch of them buying it, that pushes the price up because the wholesalers and market makers, even if they think you don't know anything, there's a limit to how much inventory risk they want to take. So if a bunch of retail investors say, "I want to buy, I want to buy, I want to buy," the market makers just say, "Well, we're going to raise the price because we'd like to, we don't want to lose money if things go the wrong way, even if you don't have particularly good information." So I think prices can get driven up a little faster, behavior coordinates more quickly. Psychology probably hasn't changed a lot fundamentally, but the technology's changed.
Moving to platform design, your work on Robinhood highlighted how its simple, gamified interface attracts many first-time investors and focuses attention on most popular and top mover lists. In light of these findings, what responsibilities do trading apps have in protecting or educating users? How could platform design be altered to mitigate the herding and impulsive trading you observed?
That's a Okay. That's a multi-dimensional question.
Okay.
And many years ago, like many, I think, I don't know, decade and a half or maybe longer, I could look it up. I gave a talk in Chicago for a conference that Morningstar put on. Now it has to have been it was over 20 years ago. And I put up some videos that had brokerage firms had run, videos of ads they had run, probably many of them like 1999, the dot-com bubble. And I point out that the videos really, they were just encouraging. They're saying anyone can trade, and people are getting rich by trading. And a couple of videos that I showed were a character in these ads from Ameritrade called Stuart. What I didn't realize when I put my talk together was that the speaker after me was the CEO of and founder of Ameritrade. And I thought, I was a little embarrassed because I didn't want him to think I had picked those videos because I knew he was coming. I picked them because they were prime examples. And I had just written a paper about advertising in the brokerage industry, and I wanted to talk about that. He was great. He got up and he said, Professor Odean says people shouldn't trade so much. Yeah, he's probably right. It's a free country and we're just making it cheaper. It's like, you know, I've got a product, it ain't poison, but it's also not like health food. And I'm making my product cheaper and I'm trying to sell it. So it wouldn't be very hard to design choice architecture, say at Robinhood, that would encourage people to trade less speculatively. What do you think that would do to Robinhood profits?
Go down.
Yeah, so why are they going to do that?
Hmm.
The morality, I think in general, companies look to see, well, is there, my impression is many companies say we want to maximize our profits, but stay within the law. If if you're worried that it's like, I think you can do the equivalent. I was told I was just at a conference in Chicago, and one of the guys I was talking to said that you can or soon will be able to do the equivalent of sports betting on Robinhood. I don't know this for a fact, so please, I'm not absolutely sure. This was what someone said to me. He said it's structured as a prediction market. In any case, well, ignoring Robinhood, let's not pick on Robinhood. Let's look at something like sports betting. Is that good for people's financial outcomes in general? Not for the occasional winner, but in general, no. Do they get enough entertainment utility to justify what they lose? That's a tough decision to make. I'll let some other economists figure that one out. Why do we have sports betting now and we didn't when I was a kid? Well, where I grew up, it was illegal. Now it's legal. If you don't like it, if it's legal and it's profitable, you're going to find it. It's going to be there. And I think probably the people at Robinhood are going to say, look, we make it easy to trade. We want people to trade. If someone wants to pass a regulation somehow that curtails how we do that. I think at one point, Robinhood had digital confetti that dropped when you placed at least your first trade. I remember this because I opened up an account on Robinhood because we were writing about it. And I thought, well, you should take a look at the thing you're writing about and try to understand it. And I was sort of amazed at how easily I could place my first trade. Like I transferred some money from my bank account. I thought I was going to get a message that said, in 3 days, when your bank transfer clears, you'll be able to place a trade. But no, I could place a trade immediately. And, the digital confetti came down. And it's like, yay, celebrate. And I think the SEC, I believe, and again, this is what I was told, and I haven't documented it, but that the SEC said, no, that's a little too much. Yeah, I mean, I'm a bigger fan of Jack Bogle. Do you guys know who Jack was?
No.
Oh, you got to read your history, man. He founded Vanguard, and he's the reason mutual fund fees are generally so low today. Mutual fund fees used to be much, 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 much higher than they are. And Jack just came along and Vanguard offered low fee funds, and they did not spend a lot on marketing. They did not, they weren't paying front end loads and all this. They just offered well diversified low fee funds. And they just kept doing it and kept doing it and kept doing it. And it took a while, but suddenly, investors started to realize, like, wow, fees matter. Not all investors, but a lot. And Vanguard's pretty big today. And could you say, well, is what they sell perfect? No, it's not perfect, but no, it's pretty good for what it is. Their fees, and they've driven the fees for the competition down. I had a, I had a dinner with Charles Schwab's daughter Carrie in some years ago in Boston. It was really fun. We were just talking about personal finance and all these things. At one point, she says to me, "Schwab's S&P 500 index fund is cheaper than Vanguard's." I was like, "What?" She said, "Go look it up." I went back to my hotel and looked it up, and it was 1 basis point. That's 1/100th of 1% cheaper than Vanguard. And that was true. But I also believe that if Jack Bogle hadn't pushed low fees, the other mutual fund companies, it would have been a much longer time before they brought prices down. But I don't know, but I suspect Jack didn't make as much money as the founders of Robinhood. Again, I don't know. I've not looked up anyone's net worth, but that'd be my guess.
So looking more closely at gamification, the Robinhood study describes features like free stock giveaways and what you talked about, the celebratory confetti as new members hit milestones. Such gamification makes trading engaging but possibly addictive. Do you see these design elements as dark patterns that exploit behavioral biases? What design principles would you recommend to ensure trading platforms encourage informed decisions rather than impulsive behavior?
This goes back to the same thing. Like, why should they?
Yeah.
Yeah.
I mean, some will, yes. Is it the right thing to do for the customers? Yeah, probably. But they're making their money off of trading. Can you design something that discourages highly active trading? Of course you can. But I don't expect to see that soon. As far as applying behavioral economics, behavioral and in general decision theory, it cuts both ways. When I now teach personal finance to large classes of undergrads, but I used to teach behavioral finance, and I would say to the class, well, I'm teaching you stuff, a lot of which I learned from Danny Kahneman about how people make decisions, and I hope you use that to improve the world, to help people, but it cuts both ways. You can learn about human psychology and try to influence people, and there's nothing about the tool that says it's always going to influence people to do things that are in their own best interest.
Turning to herding, you described the GameStop and Reddit episode as like a supernova of herding
I
events.
did.
Allegedly. Allegedly.
I Boy, did I say that? I didn't say that. I guess my co-authors have started to write a little bit more exuberantly than I thought. I'm sure I read our own paper, but okay.
Okay.
All right.
What unique factors, such as social media coordination or platform outages, made this episode so extreme compared to historical herding, such as TV-driven trades in the 1970s? More
Sure.
generally, how do social media and instant communication amplify or alter traditional herding effects in markets?
All right. So basically, I've answered that question,
Yeah.
right? I think that the technology, the social media, the speed of the internet, it has made it possible for investors to actually observe what other investors are doing and hear what they're thinking. While before, people reacted similarly to the same signals. Like they might have reacted the same way to a news event, but they didn't directly know that other investors were saying, "Hey, let's all go do this," or "Hey, let's all go do that." So it intensifies the herding and it also compresses the time frame. Yeah, and enough has been said about GameStop. You can watch the whole movie.
So following on market efficiency, your studies found that herding-driven prices spikes tend to reverse quickly. For instance, stocks subject to retail herding jumped substantially on the trade day, but then earned negative returns after 20 days. Does this pattern reinforce the idea that markets are efficient in the long run, with mispricing corrected by smart traders? Or do these events suggest lasting inefficiencies that retail behavior can create?
Yeah. Certainly the studies that you cite don't answer that question. They might make suggestive. What it looks like is you clearly get short-term inefficiencies in the sense of that there's often no good reason to say, well, the price was, $10 yesterday and it's 17 today and there was no news. I mean, that's people, except for that people were buying uh, and then it reverts it back. First of all, I think there's no particularly good reason to think that where it reverts to is now somehow the efficient price. And if you look at a lot of these events, you'll see a big run up in price and then it drops down. And for some of these, there is no information. So do you guys know about this, what happened with Signal some years ago, a few years back? Elon Musk had a tweet. I think it said something like use Signal.
Oh yeah, exactly.
And
Yeah.
and the Signal he was referring to was an app that is not a publicly traded company. And there was a publicly traded company with a ticker that basically says it's a 4-letter, it sounds like Signal. And the price just shot up. I've got a graph of it someplace, but it just shot up. And it was just totally a misunderstanding. Like it's like they had the wrong stock. Elon loves it. Not even the right stock. It goes up. There's plenty of information in the news by Thursday. I think he made his tweet like either on a Wednesday or Thursday morning. By Thursday afternoon, if you're reading, you realize that people are buying the wrong thing. Then Friday, even on Monday, though, people are still buying it. And then it comes down and then it flattens out, but it never got back down to where it started. It was still like, it gone up to some hundreds of, like from under $10 to a few $100s. And again, I might have the numbers right, but you can look them up. And then drops down. And so maybe now I haven't looked lately, but it settled down, let's say at 20, which was still 2 or 3 times where it had been to begin with. And I think part of what happens is not everyone who buys, when they realize, like, how do you feel? You bought something at 10 or 15 times the price it had been at yesterday because you misunderstood a 3 a.m. tweet. And you feel like, but not everyone's first reaction is, well, I'm going to sell immediately for a loss as this price is going on. There are lots of people just say, well, hold on, maybe it'll come back. I don't. And so you don't end up with everyone who bought selling. And some of the people who originally owned it and sold it, they're like, they're out. But so the price doesn't, even when there's zero useful information, the price does not necessarily have to go back to where it started. So, I'd be hard put to say that in the case of Signal, the efficient market said that after several months, Signal should be worth 3 times what it had been worth to begin with because of an aberrant, misunderstanding of a middle of the night tweet. So the fact that these things settle back down doesn't prove that markets are efficient, but it does sort of say that short-term price pressure, when it goes away, things are going to gravitate back more in the direction of, say, common sense. Yeah. I believe that, I'm not a big fan of claiming that the market's always efficient or that, the current trading price really tells you like, what the company is worth. I do think that the more time there is, the more things, gravitate back to people looking at like, well, what's it earning? Is there any reason to think it's going to grow faster than other firms in the same industry? So, I do think that fundamental analysis, financial statement analysis, digging in the company makes sense. If I were an analyst, that's what I'd be doing, but I'm not.
On Twitter and Reddit and whatnot, there's become sort of a slur almost. It's for people who buy something and then keep on holding even when they're in such a deep loss, and it's basically over just in hopes of one day increasing and making back their money. It's called people call each other baggies all the time. That's a common term.
Ah, okay.
But
Yeah, I guess.
shifting to market structure, high frequency trading has made bid-ask spreads narrower for small investors. From a retail investor's perspective, should we view algorithmic trading as a positive because of lower transaction costs or as a potential source of risk?
I don't have a good answer. I seriously, it's like the system of clearing trades has changed quite a bit. It's no longer trades get sent to the New York Stock Exchange and there's the limit order book and the specialist, and most of the retail trades are now going to Virtu and Citadel. I was giving a talk last week about this, and I said, in my opinion, Citadel makes too much money. But if you'd asked me 30 years ago what I thought about the specialists at the New York Stock Exchange, I would say, well, in my opinion, they make too much money. And by too much, I mean, I actually think they're making more than the service they provide is worth. And you might say, and part of that is like, Citadel has a lot of infrastructure built up, but it doesn't appear to be taking all that much risk, at least not in that market making area. Our retail, there's a debate, and I'm not going to try to answer a question in a debate for which I don't have enough information. In other words, what's the counterfactual? If you went back to a market, like to an exchange where everything came in to the same exchange, who would be better off? I don't know. It's possible retail investors are benefiting from this current system. It's possible they're not. In a way, so what's the obligation of a firm like Citadel when they take a trade? They have to do no worse than the existing quotes, right, which are set on the exchange. And they usually do a little better, but as you know, we have our paper about sub penny, a sub penny for your thought. They give you sub penny price improvement a lot of the time. If you sent that same trade to the New York Stock Exchange, you might get a worse fill. But the spreads are also higher than they would be if the exchange didn't have adverse selection. In other words, if the sort of is like the high-speed trading firms that are wholesalers, they're cherry picking the order flow. They're saying, we're going to take the people who we don't think know anything. So I don't know what the equilibrium would be with a different market structure. As far as front running goes, I doubt that I doubt there are a lot of $100 trades being front run. If I were placing big trades, I'd be worried about being front run, but that's not going to happen.
So considering demographics, given changes in the investor base, such as more women trading and younger investors entering via apps, have you observed any shifts in the gender or generational patterns you documented earlier? For instance, do younger men still exhibit more overconfidence than women, or is the gap narrowing as overall financial awareness changes?
Yeah, as I said, I don't know the answer. I just don't have the data to answer that. If I could get a data set today, like I got account level data in the late 80s and the early to mid 90s, I could probably make make a stab at answering that question. If you ask my opinion, do young men still trade a lot? Yeah. And if you ask me, do I think there are more young men or young women trading on Robinhood? I'd have an answer to that one too. Uh, and then, there's a lot going on. Whenever you look at the world in time series, there's a lot going on. You could say, okay, are people trading more actively because of demographic changes? Or are they trading more actively just because, all you have to do is go boom, 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 boom. I can easily place a trade in under a minute. When I first started, trading, actually before I even finished my BA, I wasn't trading. It's just individual trading. I had to call up a broker. And if the broker was on the phone with someone else, I'd leave a message or I'd call back and say, I want to buy this. And then we'd chat for a little bit. And then, it was a more time consuming process. Now you just open up an app and it's fast. So if you said, well, are people trading more actively today because of demographic shift or because of technology? I'd say, well, technology must be the dominant reason, but I can't say for certain how much demographics matter.
And to end off our interviews, we always ask our interviewees the same questions so that we can sort of cross compare across a large, diverse group of people. So,
Yeah.
how do you define success, both personally and professionally?
Oh, well, this gets close to something I talk about in my personal finance class. My co-instructor, Rob Shea, and I teach 1,800 students a year about personal finance. We cover investing, 401ks, insurance, credit cards, and we also talk a little bit about career choice. And I talk about the finance of career choice and say you should pay some attention to the money. You want to pick a career where you feel fine and comfortable with how much money you make. You feel secure, you feel fine. But you also want to pick a career. I think most people are happier in a career where they feel they're good at what they do, they're appreciated by others for what they do, and I think a lot of people care about whether they're making the world at least a little bit of a better place. So for me, uh, professionally, and that to some extent personally, it's like I like what I do. That's good. Uh, I think my research has made a small contribution to understanding, you know, how individual investors behave. And you ask the questions about can you design things to make it better for individual investors? I point out that not all firms necessarily want to do that, but you can do that also. And in some places, it wasn't my work that got extended into this, but the people who did work on the importance of defaults actually got Congress to pass a bill saying that companies could default their employees into a well-diversified portfolio and not necessarily default them into money market funds where many employees would just sit for years and years and years. So you can use behavioral finance and behavioral economics. It can be used to make the world a better place. Uh, I don't think I can point to research I did that has been, nothing has been that influential in terms of where I'd say, yeah, I made the world a better place. But, I hope a little bit. I certainly don't think many people have read my papers and decided not to trade. Although one woman wrote to me once, and this is years ago, she wrote and said, Professor Dean, thank you so much. My husband has controlled our investments. And I always felt he was just trading really too much. And then I read about your study, and it gave me the confidence to go to tell him to stop doing that with my part of the money. So I thought, like, one person's a little better off. Uh, but I also like what I do in teaching. I think that teaching students how to navigate the current personal finance environment they're in is really helpful to them. It's not a substitute for good institutions. I'm teaching people. I find myself teaching people about like how does an HMO work and a PPO and why you should probably if you get turned down on a health insurance claim, you should and you think you shouldn't have been, you should read the your policy and appeal if you think the wrong decision was made. None of that is a substitute for having a better system. We have a very expensive and convoluted health insurance system in this country, which, uh, you know, it's one of the areas where I think many other wealthy countries have a better system. But I still feel like this is the environment we're in, and helping these students get off to a good start. Yeah, something I feel good about.
Thank you so much.
Thank
Um,
Great,
you.
guys.
this was a great deal of fun to research your stuff, and I had interviewed a trader. I don't know if you're familiar with John Arnold last December, and we talked a lot about psychology and trading psychology. So it was kind of cool to come back into it and revisit that. And then also, so I have two sorts of clubs where I've one where I interview all kinds of people like yourself. Whether that be philosophy, computer science, business people, whatnot. And we sort of put those together and put them as articles and post the videos. And then I also have another club where we do investment analysis, and I plan to major in something finance related, but I haven't had too much luck getting finance professors such as yourself because just more busy than like philosophy professor or something like that. Um, but we have about so thank you very much for joining. But we have about 100 writers at three schools, and we put out weekly investment analysis, and we've gotten millions of views on that. And then I also over the summer we were sort of me and a few friends at school were building up connections to other schools, and that's where I brought this club too and the other club. And we have about 20 high schools across mostly Houston, which where me and Marcelo are right now, and then also a few in Nigeria, just because a friend had moved over there. But right now we're creating a financial literacy course that we're going to try and, or like personal finance course that we're going to try and put out to them. So any sort of insight from you, or if we could send that over to you, and or if you could share some material that you're already using or insights like that.
Okay, I made about 50 videos on personal finance topics. They are on YouTube and Vimeo. You're welcome to use them. They're there for anyone to use, and I use them in my class.
Okay, perfect. Thank you
So
so much.